Is the era of cheap money over? And what does it mean for people in the market for a new home or a new vehicle or maybe a business expansion when the Federal Reserve keeps interest rates flat? Welcome back to the States. I'm Greg Bishop. For this week's Everyday Economics, I talked with PhD economist Orphe Divounguy, and we continued our conversation about the actions the Fed took last week in keeping interest rates flat and what that means for mortgage rates and the housing market. Orphe, last episode we talked about the actions the Fed took last week and the market's reaction. We've got new numbers that are expected later this week about the jobs market. A lot of uncertainty. The Fed's not really laying things out clearly on how the market should react. The new Fed chair seems to be saying, hey, look at the data yourself and react. So a lot of different moving pieces there. But bottom line, when it comes down to the economy and how people are impacted, it seems like we're getting away from the era of cheap money.
Yeah, well, so many factors have shifted rates higher, but also this added uncertainty is only going to cause things like mortgage rates to increase. And we're seeing that right now. Mortgage rates touched roughly 6.8% last week, according to Mortgage News Daily. Back at basically last year, same time last year's level. Now, the big difference is last year in August, rates were actually falling. And so we had a decline in mortgage rates from August to about February of 2026. Since then, rates have been climbing. Higher rates this year relative to a year ago could actually slow down activity in the housing market. Borrowing costs are remaining elevated. The uncertainty is also going to impact the labor market potentially by keeping, employers on the sidelines, right? You're not going to go ahead and invest and create new jobs if you think there will be more volatility and if your borrowing costs are also on the rise.
And it's not just going to impact borrowing for new homes, and people may be looking to refinance their current mortgage, hoping, hey, I might be able to get some cheaper rates down the line. It's just gonna add uncertainty to those who are wanting to get into that marketplace, right?
That's right. Higher uncertainty, maybe a kind of sluggish or kind of frozen labor market, right? Those are just not things that actually support housing market activity. And so there are massive headwinds going into the rest of the summer and the end of this year.
Now, obviously, the housing market's a very diverse market. There's people who are looking to buy homes for the first time, have a first-time family home, but then there's those who may be looking to downsize, to get out of something into a different place. And then you've got the high end, right, where people are able to go out and buy multi-million-dollar homes. Who's most impacted on that kind of spectrum? Who's most impacted by this type of uncertainty?
Totally. Look, it's the lower end, right? It's the people that, can't react. They can't move. They can't do anything when rates shift. They're simply priced out completely.
Just stuck.
They're stuck. That's right. And you're seeing it a lot at the bottom of the distribution, this kind of starter homes. According to Zillow data, sales for starter homes were down 5.4% on a year-over-year basis. Whereas when you look at the top end of the market, sales are up 6.2% on a year-over-year basis. Well, what could be at play here? Well, look, when the wealthier have more discretion. They can move things around, but also the stock market. Despite the dip we saw during on Fed Day last week, the stock market recovered. The stock market has been on the way up for the past year and continues to go up, right? And so those stock market gains, especially surrounding, the San Francisco area, where you have a lot of these AI companies, those stock market gains are likely playing a big role in explaining why the top end of the market basically outperforms the rest.
It's kind of a fascinating dynamic there where all the uncertainty seeming to really keep those who are in the lower spectrum of the market held there, but seeming to give some big moves to those who can afford to make those moves. But elsewhere down the consumer line there, Orphe, I mean, we talked about interest rates and the impact on housing. What about the impact on businesses, right? Who are looking to expand, who are looking to, they've got their business models growing. They want to hire more, but they don't have the cash on hand right away. What is this market uncertainty, this interest rate uncertainty with the prospect of it possibly going up before the end of the year? What does that mean for businesses out there wanting to invest?
Yeah, I mean, borrowing costs have been elevated for a while, right? And so it's really a squeeze on the businesses that can't raise the funds in the stock market, essentially, right? So these businesses that have to borrow are finding themselves, facing much higher interest rates than they did only a few years ago. And that's a problem, right? And so that combined with, where demand is going, right? So if the top end of the wealth distribution accounts for all of the consumption, most of the consumption right now, it's hard to tell whether or not demand for your goods and services will be there tomorrow. And so very few business owners want to invest into this environment where they just don't know whether consumers are going to be able to make it work, right? To whether the math is going to work to fuel consumption spending in the next few months. And so I think that's problematic for most business owners.
Orphe, the past couple of episodes here, we've talked about the actions of the Fed, the interest rates being held steady, the impact on the markets, the impact on the possibility of the jobs numbers this Friday. You've got also the housing market and all of this. Have we seen this type of thing before in the past? Is there something we can look back on and say, okay, well, here's kind of the trajectory out of this?
It's hard to say. I mean, we usually the Fed is very good at dealing with one shock, right? We get one shock and we can deal with it. When you get many, many shocks kind of coming at the same time,
right?
The job becomes very, very difficult, right? If, for example, we have inflation above 2%, which we do, and the labor market were to start cracking at the same time, the Fed would get stuck between the two, between its dual mandate, right? Do we fight inflation by keeping rates elevated or even raising rates in an environment where the labor market's already sluggish and even deteriorating? That's a big question. That's a hard question to answer. And the opposite, right? The opposite could be true, right? You could end up with, You could end up with an acceleration in the labor market. If you do that, if you have that, then the Fed is in a better position to actually raise interest rates, right? It makes the job easier. And so having multiple shocks converging at the same time could make the job for the Fed much more difficult. And so those competing, that dual mandate could mean basically competing factors, right? Inflation up higher in a time where the labor market is not doing really well. So the best thing that could happen for the Fed right now is a strong labor market. A strong labor market, or at the very least, a labor market that is no longer deteriorating, is a positive for the Fed because it would justify either holding rates steady or even potentially raising them later. If the labor market were to come in weaker on Friday, then the Fed is in a lot of trouble. Because does it hold interest rates here? Does it raise them at a time where households are being squeezed and businesses are being squeezed? I don't think that Fed would be prepared to do that, and so the job becomes really, really difficult. If it did indeed decide to cut to save the labor market, then what would happen to inflation? Is the big question. Inflation could actually start moving higher, and that could be problematic as well. So this Fed could be stuck if the labor market weakens from here on.
Well, definitely very valuable insights that you'll find here with Everyday Economics. So be sure to subscribe today to get the latest here with The Center Square. I'm Greg Bishop, Orphe Divounguy, PhD economist. Greatly appreciate your time as always.